Hello traders, welcome to Easy Forex Strategy, your go-to channel for everything trading. In today's video, we're diving deep into the world of order blocks. Whether you're a seasoned trader or just starting out, this video will provide you with all the knowledge you need to master order blocks. Here's what we'll cover in today's video. What is an order block? How to identify order blocks on a chart. 4 ways to draw order blocks in different market conditions. How order blocks are used in trading. Common mistakes to avoid when using order blocks. And as a bonus, make sure to follow our Telegram channel for updates on upcoming videos, free weekly market analyses, and trading signals. Plus, for a limited time, following our Telegram will get you a free ebook about order blocks. Order blocks are formed when a large number of buy or sell orders are placed at a particular price level. These orders can come from various market participants, such as hedge funds, institutional investors, or banks. Order blocks are often found at key support and resistance levels on a price action chart. When price approaches an order block from below, it may find support as buying pressure to increases price due to the accumulation of buy orders within the order block. Another way to understand order blocks. Large volume orders. Order blocks consist of large buy or sell orders that can influence the market direction due to their size. Price reaction. When price approaches an order block, it often reacts strongly, either reversing direction or pausing due to the absorption of the orders. Institutional activity. These blocks are typically associated with institutional investors who have the capital to place significant orders, unlike individual retail traders. Market structure. Identifying order blocks can help traders understand market structure and potential future price movements. They can indicate areas where price is likely to reverse or consolidate. Before we delve into more advanced topics, we must first cover the fundamentals. A solid understanding of how a candlestick is formed is essential before we can proceed to more complex concepts such as order blocks. Let's start by examining the basic structure of candlesticks. There are 2 primary types of candlesticks, bullish and bearish. Both types share similar characteristics in terms of their high and low points. However, the key difference lies in their opening and closing prices. A bullish candlestick opens at the bottom and closes at the top, indicating a rise in price over the period. In contrast, a bearish candlestick opens at the top and closes at the bottom, signifying a decline in price after reaching a lower low. Every candlestick consists of a body, which represents the range between the opening and closing prices. This body can vary in size depending on the price movement during the period. However, it's important to note that there are also special types of candlesticks that might not have a typical body, such as the doji, dragonfly doji, and gravestone doji. These candlesticks have unique formations and implications, but we won't be covering them in this particular discussion. Instead, we will focus on these special candlestick formations in a subsequent video. Order blocks on a chart are created after a significant impulse or continuous candlestick pattern, and we draw our order blocks based on the previous candlestick. Order blocks on a chart can be identified by a sequence of candlesticks. These sequences can consist of 4 or more candlesticks. The sequence can continue until a different candlestick pattern appears, which will signal the end of the order block. Here, we can spot that there is only one bearish candlestick before a series of bullish candlesticks that indicate an impulsive move. This single bearish candlestick is where our order block will be identified. We can also find that there is an impulsive move that created what we call a change of character. From this demonstration, we can also observe the establishment of a new higher high and a new lower high. Additionally, it is evident that the price respected the bullish order block precisely. From this example, we can see that we have identified our bearish order block at the last bearish candlestick, before price moves aggressively to the downside. On the order block level, it might appear similar to support and resistance levels, but they are quite different. Order blocks use precise price levels to accurately identify significant price points for potential trade opportunities. In this section of the video, you will learn 4 ways to draw order blocks. On this first example, Because there is only one candlestick before a series of bearish candlesticks, we will draw our order block from the high and low of the bullish candlestick. By doing this, you ensure that you never miss a trade opportunity. Once you become accustomed to identifying these candlestick patterns to draw order blocks, it will become easier to understand and locate them. However, as traders, we aim to minimize risk as much as possible. This is where the refined order block comes in. From the same order block, we can draw it slightly differently by marking it from the high of the bullish candlestick to the open of the same candlestick. By doing this, we ensure that we reduce the risk of entering the market too early, thus minimizing risk. However, the downside is that this approach might cause you to miss many trade opportunities. Currently, we can observe a series of bearish candlesticks before a break in market structure. This series of candlesticks forms the base and the origin of the order block. In this case, you will draw the zone from the high of the first candlestick to the low of the last candlestick in the series. Previously, we noted that refining order blocks can mitigate risks. Even in similar situations, refining order blocks remains applicable. Here, we'll simply utilize the most recent bearish candlestick to delineate the zone. Also, if you are enjoying this video so far, please consider subscribing to the channel. Give this video a like and leave a comment below for more topics that you will want us to cover in the near future. In this section of the video, we will discuss the different types of wicks on order blocks. When drawing an order block, if the candlestick's wick extends beyond the block, we opt for the lowest low instead. This ensures the safety and accuracy of our analysis. Type 2. If the candle forming the order block exhibits a lower low, we will still utilize the lowest low in our analysis. Type 3. In situations where the market produces equal lows, we will still use these lows in our analysis since they hold the same price. On this section of the video, we will discuss how order blocks are used in trading. Identifying potential reversal zones. Traders look for order blocks to find areas where price might reverse. For instance, if there is a large buy order block, price might reverse upwards upon reaching this level. Entering and exiting trades. Traders use order blocks to determine optimal entry and exit points. Entering a trade near a buy order block or exiting near a sell order block can increase the probability of a successful trade. Market structure. Identifying order blocks can help traders understand market structure and potential future price movements. They can indicate areas where price is likely to reverse or consolidate. Confluence with other technical analysis tools. Order blocks are often used in conjunction with other technical analysis tools like trend lines, indicators, and Fibonacci levels to increase the accuracy of trade setups. Misidentifying order blocks. Mistake. Traders often mistake regular support and resistance levels or minor consolidations for order blocks. Solution. Ensure the identified order block is characterized by significant volume, clear consolidation, or sharp price movements. Use higher time frames for confirmation. Entering trades prematurely. Mistake. Jumping into trades without waiting for confirmation can result in false signals. Solution. Wait for confirmation signals such as a candlestick pattern, pin bar, engulfing candle, or a price reaction to the order block before entering a trade. Ignoring volume analysis. Mistake. Not paying attention to volume when identifying and validating order blocks can lead to incorrect assumptions. Solution. Always analyze volume during consolidation and at the breakout or breakdown points. Significant volume increases the reliability of the order block. Ignoring higher time frames. Mistake. Relying solely on lower time frames like 1 minute or 5 minutes charts can lead to identifying less significant levels. Solution. Use higher time frames, like daily, weekly, to identify major order blocks that reflect significant institutional activity. These levels tend to be more reliable. Neglecting risk management. Mistake. Traders might place stop-loss orders too close to the order block, resulting in getting stopped out prematurely. Solution. Place stop-loss orders at a safe distance beyond the order block to account for potential market noise. Use appropriate position sizing to manage risk. Overcomplicating analysis. Mistake. Adding too many indicators and analysis methods can lead to analysis paralysis. Solution: keep your analysis straightforward. Focus on key elements like price action, volume, and higher timeframe order blocks. Overlooking market mistake: not considering the overall market context, such as the broader trend or economic events, can lead to incorrect assumptions about order blocks. Solution: always analyze the broader market trend and be aware of upcoming economic news or events that could influence price action. Failing to recognize order block validity mistake: assuming an order block will always hold can lead to losses if the market conditions change. Solution: continuously reassess the validity of order blocks. If price breaks through an order block with significant volume, it may indicate a change in market sentiment. Over-relying on order blocks mistake: relying solely on order blocks without considering other aspects of technical analysis can limit trading effectiveness. Solution: integrate order blocks into a broader trading strategy that includes other technical indicators and market analysis techniques. Traders, I guess this is the end of our video. Stay tuned for another video on Monday, and head over to our Telegram now to get your limited edition ebook today. And also, don't forget to subscribe to the channel as it will help us to make great content.